To begin with, let's discuss about different types of plan. The first one is Simplified Employee Pension Plan. A business of any size, even self-employed, can establish a SEP. Under a SEP plan, an employee must set up a retirement account to accept the employer's contribution. In SEP plan, employees cannot elect to contribute to the plan based on payroll deductions. That is, it is completely employer-funded plan. The second one is Simple IRA plan. This is basically an extension of SEP IRA. In this employee salary deferral can happen. That is, employees can elect to contribute to the plan based on payroll deductions. It is ideally suited as a startup retirement savings plan for small employers not currently sponsoring a retirement plan. Next one is Profit Sharing Plan. This plan is basically fully employer funded. It is up to the employer to contribute. Also, there is no set amount as per the law that employers should contribute. Company can contribute to this plan for 1 year and can skip the other year. It is totally up to the employer. The fourth one is Defined Benefit Plan. This is like a pension plan, like defined benefit plan guarantees a specific amount of payment upon retirement. Benefits paid are typically guaranteed for life and rise slightly to account for increased cost of living. Employer's contribution is mandatory in case of defined benefit plan. Next is 401k plans. This is our primary area of discussion. These are plans employers offer to attract and retain top talent in the organization. The two main types of 401k plans are, first is traditional 401k plan. A traditional 401k plan allows eligible employees, that is, employees eligible to participate in the plan, to make contributions through payroll deductions. In addition, in a traditional 401k plan, employers have the option of making contributions on behalf of all participants, making matching contributions based on employees' elective deferrals or both. The next one is Safe Harbor Plan, 401k plan. A Safe Harbor 401k plan is similar to a traditional 401k plan, but among other things, it must provide for employer contributions. That is, in this case, employer contribution is compulsory and not optional as was in the case of traditional 401k plan. Most of these 401k plans have plan website where employees can log in and make changes in investments and many other things. Edith will take us through this after a couple of slides. Next is parties involved in running a 401k plan. There are various parties involved in management of a company's retirement plan. First one is plan sponsor. Plan sponsor is the entity, generally the employer, responsible for establishing and maintaining the plan. In other words, it's just another name for your employer who has set up and oversees your 401k plan. Next is record keeper. Record keeper is basically the one who maintains the books of accounts and basically the bookkeeper for the 401k plan. The main duties of a record keeper is to track everything, like who is in the plan, what investments they own, how much is invested and what type of money is it, like the money is from payroll deduction or employer matched portion, etc. Next is trustee. Trustee is someone who has the exclusive authority and discretion to manage and control the plan assets. The trustee of the plan has the primary fiduciary responsibility for ensuring that plan assets are managed for the best interest of the plan participants and their named beneficiaries. In particular, trustees must follow the plan's rules in administering the plan, and they must follow the standard of care that a reasonable fiduciary would follow in fulfilling their responsibilities. Custodian is the one who holds the actual investment assets and handles buying and selling of investments over time. So, a trustee manages assets on behalf of a beneficiary or a trust, and whereas a custodian is the entity that actually holds the assets in question for safekeeping. The last one is plan administrator, the person who is identified in the plan document as having responsibility for running the plan. It could be the employer, a committee of employees, a company executive, or someone hired for that purpose. If we have hired third party as an administrator, we call it as third party administrator TPA. Administrator basically ensures that the plan is administered in accordance with the plan documents. Administrator executes or oversees day-to-day activities of the plan and may even serve as a record keeper in case separate record keeper is not appointed. Next, we'll discuss different types of 401k audit. Company-sponsored 401k plans with more than 100 participants are required to get 401k audit done by an independent CPA. There are two types of 401k audit. First is full scope audit. In full scope audit, auditor audits everything, including participants' eligibility, 401k loans, investments, and so on. The auditor assesses the reliability, fairness, and appropriateness of plans' financial information as reported by the plan management and issues an opinion on whether the financial statements as a whole are free of material misstatement in case of full scope audit. Second one is limited scope audit. The only difference between full scope audit and limited scope audit is that in case of limited scope audit, the auditor does not perform auditing procedures on investment information that is certified by eligible entity acting as a custodian to the plan. So, if your 401k plan investments is held by a regulated trust company, bank, or an insurance company, you may be allowed a limited scope audit, as these three institutions are qualified to certify the accuracy and completeness of your investment plan investment information. In case of limited scope audit, auditor does not provide opinion on plan's financial statements, as he will be skipping the investment information from testing. Or we can say he issues a disclaimer of opinion. And now Edith will be discussing on summary plan description. Over to you, Edith.
Thank you, Suchita. My name is Edith Miranda Smith, a CPA from our Cerritos office, doing both tax returns and audits, and I've been with the firm for 20 years. So in the next few slides, we will learn about auditing a 401k plan. First is you have to know the company's plan description, or SPD. And second is to know the IRS and DOL rules. So what is a summary plan description? This describes in detail all of the features of the plan. Almost all basic questions an employee might have about the function and management of their plan should be answered in the summary plan description in a plain and non-technical language. Your plan administrator or your employer is required to provide you with a copy of the summary plan description within 90 days after you become a participant in the plan as per ERISA. If an employee requested a copy of that summary plan description, the sponsor or employer has 30 days to provide it. So what are the common features you will find in the summary plan description? First is eligibility. This is when an employees are eligible to participate in the 401k plan. It can have age requirement or length of service requirement. Based on statistics gathered by IRS, 64% of plans uses 21-year-old as age requirement, and 20% does not have any age requirement to participate in the plan. And for service requirement, it shows that 54% of the plan uses 1 year as service requirement, and 30% does not require any length of service to participate in the plan. So normally, 2 weeks prior to when an employee becomes eligible to participate in a 401k plan, the employer will send the eligibility notices informing the employees that they can enroll in the plan, and they have an option if they want to decline or opt out. So if an employer fails to notify the employees and then fail to enroll them in the plan, this is considered a mistake, which we call an exclusion of eligible employee. And that employee missed the deferral opportunity, and the employer needs to correct that by making a qualified elective contribution for that employee. Hansa will discuss much about that later, about the common mistakes in managing the plan and how to fix it. Second features on the SPD is contribution. An employee or participant can elect to have a certain percentage of his salary deferred from his pay to contribute to the 401k. And contribution rate can be between 1% to 100% depending on your on the company's SPD. And you can change your contribution rate or amount anytime. So let's say when I enrolled in the plan, I had 8% withheld from my salary, and now I wanted to change it to 15. I can do that by going in to our plan website and change my contribution rate. Like Chita said that most of the plan has this plan website where they can manage their account. And usually it takes, when you change your contribution rate, it usually takes effect on your next payroll. So, however, if I chose to contribute 50% or 100% of my salary, my contributions cannot exceed the 402G limit, which is 19,500 for this year. And if I am over 50 years old, I can do a catch-up contribution of 6,500. But if I exceeded this limit, then the plan has to distribute the excess deferrals to me. So if you look at your pay stub, you would see that in the deduction portion, there is the 401k contribution which you have made during that pay period. So you can calculate it, if it is correct, by multiplying your gross pay by the contribution rate that you have chosen. And also, at the end of the year, when you get your W-2, you will see the total contribution that you made during the year on box 12, and it has a code D. And also, there is also a box 13 for the retirement plan, and it will be marked check. So you can compare your total contribution to your plan statement when you go to your plan website. So what is gross compensation? 401k plans have different aspects of compensation that will be allowed the deferral. So you have to look again on your SPD what constitutes a gross compensation. It can include base wages, bonuses, tips, or commission. And some plans will not include bonus or commission or tips for salary deferrals. Investment fund options. These are the list of investment fund options available for employees to choose from where they want to invest their 401k contribution. This is pre-selected by your plan administrator. So, and you can change this investment options anytime also by logging to your plan website and make the changes. So now that the employees have contributed to the 401k plan, the employer has to deposit those contributions to the plan trust account. And DOL, or Department of Labor rules, require that the employer must deposit the salary deferrals or your 401k contribution to the trust account as soon as they can, but not later than 15 business day after the contribution were made. And there is a safe harbor of 7 business days for plans with fewer than 100 participants. So, like I said, most of the plan has a plan website, so you can check your 401k account check if your contribution, every payroll is going to your account on time, and if it is correctly allocated to your fund selection. Second is an employer contribution. So I would not be discussing much about this, but I just want to let you know that some plans provides for matching contribution or discretionary contribution from your employer. So next feature I would want to discuss is loans. Some plans permit loans to participants, and under the IRC Code Section 72P, loan rules are first, it should be a legally enforceable agreement. So it can be a paper or electronic document that states the date, the amount of the loan, and it's binding the participant to repayment schedule. It should be secured by your account balances, and the interest rate should be similar from financial institutions what they offer. Second is the amount of the loan cannot be more than 50% of participant vested account balance up to maximum of 50,000. Exception is if 50% of your vested account balance is 10,000, you may borrow up to 10,000. So let's say your account balance is 80,000 and you want to borrow 50, the maximum. You will only be allowed 40,000, which is 50% of your account balance. Or let's say you have a 150,000 account balance and you wanted to borrow 75, which is 50%. You will only be allowed the maximum $50,000. So loan terms requires participants to make amortized payment to be allocated to principal and interest, and it must be paid within 5 years unless the loan is to be used to purchase the main home. Then it can extend up to 15 years depending on the plan. And usually repayment of the loan is through payroll deduction, but participants can make a lump sum repayment anytime. And also, if an employee goes on leave, your employer may suspend repayment up to 1 year. But however, you cannot extend the term of the loan. So the repayment period will still be 5 years, and you can either just increase your payment over the rest of the term of the loan, or you can just make a catch-up payment. So if you don't follow this federal tax law, the loan now can be treated as a taxable distribution. So some plan requires spousal consent when before giving loans to participants, and also some plans allow more than one loan as long as the total loan balance is not more than the limit. When you fail to make a timely payment on your loan, there is a cure period which allows your employer a window of time to get a payment from you without it being considered a mispayment. But if you fail to make the payment during this cure period, the loan now is now in default. And you must make a lump sum payment for the missed installment, or work with your employer to reamortize the outstanding loan balance. So once the loan is default, it is now considered a deemed loan distribution, and your employer will gonna issue you a 1099-R, Form 1099-R, and report this. You have to report this as your taxable income on your income tax return. If you terminate your employment, you may be required to pay the full outstanding balance of the loan. And if you don't do that, then it will be treated as distribution, and also, again, they will issue you a Form 1099-R and report it to IRS. Okay. Next feature is distribution or withdrawals on your 401k plan. So distribution of elective deferrals or 401k contribution cannot be made until one of the following occurs: the participant die, or they become disabled, or the plan terminates, or you reach 59 and a half year old, or you terminate your employment. Hardship withdrawals. Plans may allow employees to receive hardship distribution because of an immediate and heavy financial need. So withdrawals cannot be more than the amount of your total elective contribution. So your employer will determine whether you has an immediate and heavy financial need based on all relevant facts and circumstances, and that a distribution from the plan is necessary to address the need. These are considered immediate and financial needs as defined by the law. One is it will be used for medical care expenses previously incurred by employee or their spouse or any of their dependents. Second is if it will be used for the cost directly related to purchase a principal residence of the employee. Third, will gonna be used for the payment of tuition fee or any related educational fees, for room and board expenses for the next 12 months of post-secondary education of the employee, their spouse, children, or dependents. Payments, or it will be used for payments necessary to prevent the eviction of the employee from their principal residence, or mortgage foreclosure on their residence. Or it can be used for funeral expenses for the employee's parents, spouse, and dependents. And last is it can be used for the certain expenses related to the repair of damage to their principal residence. So hardship withdrawals is usually subject to 10% early penalty if you made the withdrawals before reaching 59 and a half year old. But the 10% penalty or additional tax will not apply to withdrawals if it is due to death of participants, disability of participants. It should be total and permanent. And if they reach, like I said, if they reach 59 and a half years old, or it is because of the quadro divorce court order, or it is you're withdrawing it because you received it from your corrective distribution of excess contribution, and if you roll it over to another retirement plan within 60 days. Distribution to terminated employees. Like I mentioned earlier, if you leave your job and have a retirement plan, you have 4 options. You can leave the money in the plan, maybe because you like your previous employer's investment options and the plan has low fees. Or second is you can roll it over to your new employer's 401k plan. Third is you can withdraw the balance, but when you withdraw the balance, you will be required to be withheld 20% federal tax and 10% California tax. So if you are not 59-year-old, you may have to pay 10% penalty for early distribution tax. And fourth is you can roll it over to an IRA. But if your account balance is less than 5,000, your employer may force you to move your balance. Hansa will be discussing the common mistakes on the plan and how to fix it. So over to you, Hansa.
Hi everyone, this is Hansa. I'm a CPA working with Chuk firm for almost 11 years. I'm based in LA office. Today I'm going to discuss about the common mistakes with the benefit plan. So all mistakes related to the benefit plan can be fixed with IRS system called the Employee Plans Compliance Resolution System, which offers the three programs to plan sponsors to fix the mistakes happens with this benefit plan. The first program is self-correction program. Many mistakes in the operating retirement plan can be self-corrected without filing form with the IRS or paying any fee. Eligible operation failure include failure to follow the terms of the plan, excluding eligible participants, not making contribution promise under the plans, and loan failure. Second program is voluntary correction program. They go by VCP. Correction is same as under the self correction program, but this program generally used by retirement plan administrator when there is a document failure aren't eligible for the self correction program. A document failure occurs when you don't have your plan document up to date or if plan document doesn't fully comply with the IRS tax law. This can be corrected with the IRS by filing Form 14568 and paying applicable fees, which is based on the value of a plan's net asset. The third program is Audit Closing Agreement Program. A plan sponsor that does not come forward to IRS but whose retirement plan has a significant programs that are discovered by the IRS during the audit of the plan. The plan sponsor enter into the agreement with the IRS to make correction to the retirement plan and pay the section negotiated with the IRS. There are several mistakes happens with the retirement plan. Today I'm going to discuss about common four mistakes which even occur during the we are doing the 401k audits. So first mistake is exclusion of eligible employees. Edith already explained who are the eligible employees. So I'm going to talk about what common mistakes happen with the exclusion of eligible employees. The plan administrator failed to offer an eligible employee the opportunity to make elective deferral once they become eligible for the plan. Basically, employees are not informed and allowed to make the deferral contribution to the plan. How to fix? So I'm going to discuss with the example. So mistakes. Employer D sponsored 401k plan with 8 participants. The plan uses the calendar plan year. The plan has a 1 year of service eligibility requirement and provides for January 1st and July 1 as an entry date. Jack, employee, to whom employer D should have provided the opportunity to make elective deferral on Jan 1st, 2011, wasn't provided the opportunity until Jan 1st, 2012. So how the employer can fix this? So this is the non-safe harbor plan. So the solution to fix this error for employer D is, so say example, Jack's salary for a year for 2011 is $80,000. Actual deferral percentage for the plan for non-highly compensated employee is 8%. Jack is a non-highly compensated employee for this employer D. So missed deferral for a Jack in 2011 is 80,000 into the 8%, which is 6,400. So if Jack has given an opportunity on January 1st, 2011 to contribute into this plan, he would have contributed the 6,400 in the plan. So here, since he hasn't given the opportunity, since this is the non-safe harbor plan, employer gonna do the QNEC contribution of 50% of his missed deferral, which is 3,200. Plus, employer also has to contribute the loss earning on this contribution of 3,200, which plan sponsor can calculate using the Department of Labor has a calculator which you can use to calculate the loss earning. And this balance is fully vested. 100% should be given to the Jack. So say example, fully vested means tomorrow if Jack resign on February 1st, 2012, this 3,200 plus loss earning gonna be distributed to the Jack. How to avoid this mistake in the future? Plan administrator should monitor the census information like employee hire date, birth date, completion of services, and apply the participation requirement and make sure to avoid these mistakes in the future. The second mistake I'm going to talk about, the haven't timely deposited the employee elective deferral. So the common mistake happens here. Employer failed to timely deposit the employee's deferral to the plan on the time. So I'm going to explain this also with the example. So the mistake here happened. Employer B sponsored 401k plan for its 1200 employees, all of whom are plan participants. The plan expressly provides that the employer must deposit deferrals within 5 days after each pay. On April 1st, deferral payment went to the plan on May 1st. B discovered on the June 1st that April 1st payment went to the plan late by 30 days. So what is the solution for this employer B? The employer B discovered an error in the initial 3 months. It didn't exceed the 3 months, so no QNEC is necessary, but they need to provide 45 days notice requirement to the participants. So what is this 45 days notice? So 45 days notice is mentioned here on the slide 7 and 9. Generally include the general information related to the failure, such as percentage of eligible compensation that should have been deferred, the approximate date the compensation should have begun to be deferred, and the general information need not include the statement of dollar amount that should have been deferred. So how to avoid this kind of a mistake in a future? So coordinate with your employer needs to coordinate with their payroll provider to determine the earliest date they can reasonably segregate the deferral deposit from general asset and set up the procedure to ensure that to make the deposit by that date. The next mistake, so excess deferral. So common mistakes. Some of the participants contributed to the plan more than the 401k contribution IRS limit for a year. Say example for 2020, participant of the plan allowed to make the contribution of only 19,500. That is, if participants contributed more than 19,500 for 2020, then that is called the excess deferral to the plan. Generally, this excess deferral can easily corrected if plan sponsor refund the excess contribution to the participant by the following year, April 15. So here I'm going to explain with the slide that what happened when it doesn't distributed to the participant by the April 15. So mistakes. So employer X maintained this 401k plan that has a 21 participants for calendar year 2020 and deferred 20,000 to the plan. N is under age 50, isn't eligible to make a catch-up contribution, and N has an excess deferral of 500. 500 is excess contribution because IRS contribution limit is 19,500 for 2020. So and here employer X didn't discover this mistake until after April 15, 2021. On November 1st, 2021, X distributed the excess deferral plus earning of $10, totaling $510 to the N. So solution, what is the solution? So for since employer X discovered this error after April 15, 2021, for year 2020, the year of a deferral, N must include 500 in the gross income while filing her tax return. For 2021, year of a distribution, N must include 510 in gross income while filing her tax return. When employer X would report this amount on the 1099-R. So here you can see that N is reporting 2 times. So it becoming double taxation, this $500, since it happens after the April 15, 2021. In addition, N also has to pay 10% early distribution tax for the federal plus any state penalty. Like for California, there is a 2.5% penalty. But if This error has been discovered by employer X before April 15, 2021 and distributed 510 by April 15, 2021, then 500 will be taxable in 2020, and while only $10 earning on the distribution taxable in 2021. Plus, N doesn't have to pay any 10% earlier withdrawal penalty. So how to avoid these mistakes in the future? Plan sponsors should work with the plan administrator to ensure that the plan administrator has a sufficient payroll information to verify the deferral limitation, have check and balance in a place to alert the employer and the plan administrator when limit exceed, to take timely correct, and even if limit is exceeded, to take timely corrective action, which is by April 15th of the following year. Okay, so my last common mistake I'm going to discuss about is participants' loan doesn't conform with the IRC section 72P. So what are the common mistakes happen? So many 401k plan permits the loan to the participants, as Edith discussed about in a detail. So plan sponsors should ensure that their plan document allows the loan before allowing participants to borrow the money from the plan. Some plan documents include the complete description of loan rules about what the loans are required and the requirement. Here I'm going to discuss about through the example some 3 common mistakes and their solution. So the first mistake, Bob received the plan loan on May 1st, 2019. Loan was for $60,000 over a 5-year term, amortized using the monthly interest rate. Bob timely made the required payment. The loan amount is less than the 50% of the Bob vested account balance. However, the loan amount exceeds the maximum limit of $50,000. Second mistake, Terry received the loan of $10,000 dated April 1st, 2016 over a 6-year period. Payments are timely and the interest rate is reasonable. The loan term exceeds the maximum 5-year repayment period. The third mistake, Dean borrowed the $10,000 dated March 1, 2016 over a year of 5 period. Because of payroll error, AZ Corporation failed to withhold the requirement loan and repayments from the D's paid since August 1, 2016. The loan amount is less than the 50% of Dean's vested account balance and the interest rate is reasonable. So now I'm going to explain with the solution how this error can be fixed. Okay, so solution. So for a first mistake, AZ Corporate corrected this mistake by requiring the Bob to return the excess loan amount of $10,000. There are other 3 alternative methods also that AZ Corporation can opt to correct this error. Generally, loan that exceed the dollar limit, the participant must repay the excess loan amount and if needed, amortize the remaining principal balance as of the repayment date over the original loan remaining period. Second solution for the second mistake. So AZ Corp is correcting this mistake by re-amortizing the loan balance over the maximum remaining period, 5 years from the original loan date. On February 1st, 2017, AZ Corporation re-amortized the loan balance for Terry, so that will be fully repaid by April 1st, 2021, which is 5 years from the date of the original loan. Basically, the outstanding amount of the loan is re-amortized over the maximum remaining period allowed under the IRC section 72P, which is mostly 5 years only. The maximum duration is determined from the date of the original loan was made. Now, third mistake solution. The loan went into the default as of November 2, 2016 from the August 1st to 2016. On the expiration of the plan stated 3 months cure period, AZ Corporation determined it was partially their fault because it failed to collect the loan repayment. So AZ Corp corrected the mistake by requiring Dean to pay the lump sum repayment equal to the additional interest accrued on the loan and amortize the outstanding balance over the remaining loan period. So loan that is in a default after passage of the cure period because of the failure to make timely payments, the participants must either make a lump sum payment for the missed installment, re-amortize the outstanding loan balance or resulting in a higher payment for going forward, or combination of make-up payment and the re-amortization of the loan. How to avoid this mistake in a future? Review each participant's loan, including loan amount, term of the loan and the repayment terms. And that's all from me. So I'm going to have Eunice to talk about our last section of Form 5500.
Thank you, Hansa. This is Eunice, CPA based in Cerritos. I've been with the firm for about 18 years. Today, I'm going to discuss about the agencies that oversee the employee benefit plans and the Form 5500. So there are two government agencies that oversee the employee benefit plans like 401k. One of them is the United States Department of Labor Employee Benefit Security Administration. The agency is in charge with enforcing the rules of governing the conduct of plan managers, investment of plan assets, reporting and disclosure of plan information, enforcement of fiduciary provisions of the law, and the workers' benefit rights. They are also responsible for administering and enforcing the provisions of ERISA. ERISA is a federal law that sets minimum standards for most voluntary established pension plans in private industry to provide protection for individuals in these plans. And the next government agency that oversees the employee benefit plan is the Internal Revenue Service. They are responsible for ensuring the compliance with the Internal Revenue Code, which establishes the rules for operating a tax-qualified pension plan, including pension plan funding and vesting requirements. They also do random audits on the financial transactions of the plan that may be prohibited, as explained by Hansa earlier. The next form, Form 5500, was jointly developed by the Department of Labor, IRS, and Pension Benefit Guarantee Corporation so that pension plans could utilize the Form 5500 series to comply with the annual reporting requirements under ERISA and the Internal Revenue Code. Form 5500 was created to ensure that employee benefit plans are operated and managed in accordance with certain prescribed standards, and that participants and beneficiaries, as well as the regulators, are provided or have access to sufficient information to protect the rights and benefits of the participants and beneficiaries under the employee benefit plans. Form 5500 and its schedules are public documents that can be accessed through the Department of Labor EFAS website. The due date for Form 5500 filing is 7.5 months of the plan's year end. So, for example, the plan's year end is December 31st. The deadline would be July 15th of the following year. It must be filed online through the Department of Labor EFAS website or third-party software. They don't allow paper filing. There is an option to file an extension using Form 5558, and this allows the plan to in another 2.5 months time to file the Form 5500. So it's important to file a timely Form 5500. So it's important to file on time because there is very stiff penalties that the Department of Labor and IRS assess for late filing. It's $25 per day up to a maximum of $15,000. This one is for each year. And for the Department of Labor penalty, late filing, it's 1,100 per day with no maximum. There is an option for a lower penalty. It's called the DFVC, which is the Delinquent Filer Voluntary Compliance Program. This one, the basic penalty structure under this program is $10 per day for delinquent filings. And then there is also a per filing cap. The maximum penalty for a single late annual report is $750 for a small plan. Generally, a plan with less than 100 participants at the beginning of the year, and $2,000 for large plan. The per plan cap, the DFVC also includes a per plan cap. This cap is designed to encourage reporting compliance by plan administrators who have failed to file annual report for a plan for multiple years. So the per plan cap limits penalty to 1,500 for a small plan and 4,000 for a large plan, regardless of the number of late annual reports filed for the plan at the same time. Next, I'm going to talk about the bonding requirements. ERISA's bonding requirements are intended to protect employee benefit plans from risk of loss due to fraud or dishonesty on the part of the person that handled the plan funds or other property. Every fiduciary of an employee benefit plan is required to be bonded in accordance with ERISA Section 412. The fiduciary bond is separate agreement from the fidelity coverage that is provided under the general umbrella policy of a corporate policy. The bond may be applicable to cover several fiduciaries at one time. The minimum amount of bond must be equal to at least 10% of the amount of funds managed or handled by the fiduciary, and the minimum amount of fidelity bond is 1,000 up to a maximum of required bond amount of 500,000. That ends our presentation.